Hi, Martin Turner here. This week, Maria Tyler leads our lecture as we look at inventory. We look at what inventory is and that we value inventory at the lower of cost and net realisable value. We then see there are two methods of recording inventory transactions: the perpetual inventory system, the most common system of recording inventory, and the periodic inventory system. We then look at four methods of valuing, that is, assigning costs to inventories: specific identification, FIFO, LIFO, and weighted average. And we also talk about step 7 in the assignment. Let's start by looking at what inventory is.
So we're going through inventory today, and it is a little bit technically heavy, but hopefully I will step through it in a lot of detail so that you don't have too many questions, or you've got a good basis for forming questions and then investigating them in your tutorial groups or in your discussion forums. So that's my goal. It also relates to step 7 of the assignment. So as we go through, I'll point out different aspects. Well, actually all of it you'll need to refer to as part of your assignment, but I'll point out specific things that you might like to focus on as you are completing step 7 of your assignment. Now I'm going to make it a little bit interactive to start with, so I want you to start thinking about what you think inventory is. And I know we've got a lot of students out there with some really great experience in inventory. So if you've had anything that you'd like to share with students, and I will be asking for those who have been involved with a stock take to think about perhaps sharing that when we get to that point in the lecture. So we'll run through the concepts, I guess, the basic concepts to do with inventory, and I will go through assignment step 7 at the end using my example company of Wesfarmers, and then we'll complete with the minute paper. Okay, so please log on to Echo 360 if you haven't already. I mean, you know, you should be doing that as soon as you walk in the door, but just for those who haven't, can you log on to my slides, because the next couple of slides are interactive, and I'd love it if you could give me your thoughts. The first question I've got for you is, what do you think inventory is? So there's no right or wrong answers. I just want to know, when somebody says to you, what's inventory, what comes to your mind? Okay, so what do you think inventory is? And for those who have read the study guide in chapter 4, you'll have an idea of what we think inventory is. And for those who haven't, who may like to open the study guide and sort of refer to it and make notes as we go through the lecture today, this particular question, what do you think inventory is, relates to the very first section on page 2. So if you go to the study guide, again, that's on the left-hand side of Moodle. Click into there, click into chapter 4. You'll come to this, and this first section really introduces you to what inventories are. So if you have a quick read through, hopefully everybody has already read through that, but this will provide you with a bit of a background into what we're trying to tell you inventory is. But I'm not interested in the study guide's definition of inventory. I want to know what
ACCT 11059.
So please give me your thoughts. What do you think inventory is? What comes to mind?
Oh, sorry, that's it. Yeah, sorry.
John and Bundaberg, are we supposed to see you or not?
Oh, John, you're talking to me?
Yeah, we actually can't see you.
Yeah,
See
you're
your class.
supposed to see me. Okay, all right. Let me. I mean, you don't have to see me, but.
I'm not looking at presenting it being presented.
That's better.
I just want
Oh, sorry, that was my fault. I actually had it on class view instead of presenter view. Sorry, guys, you've been on screen. No, you've got to write it in your in the actual. So click to the next slide, and you'll see the interactive component. So, John, you can see me now. Everybody can see me now.
Yeah, everything's fine.
Sorry about that. That was my fault. I didn't press the right button here. All right, let's have a look. I've only got 2. Oh, I've got 3. This is good. I've got a few responses, so keep them coming in. So I think inventory is stock on hand, stock that is required to produce goods for sale. So the first one is textbook, study guide, So we do call it stock on hand, but what does that really mean? The second part of that is really good. Stock that is required to produce goods for sale. Okay, so we're starting to allude to something to do with the operations of our business. Stock that a business sells to generate revenue. This is good. Inventory is the stock of the business that they tend to sell on an everyday basis. Goods acquired for the purpose of resale. Inventory are the stored goods and materials that are to be used for the production of the final products and services of the corporation in future. This is good. We're starting to get into the nitty-gritty, different components, different types of inventory. And this is the sort of thing we want to read about in your Step 7. So, well done. Stocks of the company. Now, be careful when you say stocks. When some people say stocks of the company, to me, I think of shares. So when we refer to stock, we usually say stock on hand without the plural S. Stocks, this can be a bit of a slang term for shares of the company. Inventory are the goods and materials held by a firm with the intention to sell. Very good. So inventory generally means, and this is a summary of those submissions here, inventory means goods or property that's been purchased by the business and held for sale in the operating cycle of a business, which is right. The important point to realise, I guess, comes in this last submission here. Inventory is the goods and materials held by a firm with the intention to sell, because other assets may be sold from time to time, but they don't constitute inventory. Okay, so they're not on an everyday cycle, not part of our intentions to sell our assets. But inventory, we do usually buy with the intention to resell it, hopefully at a higher price, which generates then our profit. Well done, thanks for that. Okay, so again, very nice, quick, quizzy question. What names are there for inventory? And there are three to four maybe listed in the study guide, but have you come across different names to those listed in the study guide? So what names are there for inventory? So it is listed in the study guide, but let me know on the next slide with your responses. I'll just select to... So again, in the study guide, which I've just got on the screen at the moment, we've got different names for inventories, and the study guide has suggested 3. So we've got inventory, stock, stock on hand. What are some other names you might have heard inventories being called? Let's have a look. Got one person offering. So stock on hand. Oh, good. Raw materials. Inventories, goods. Yep. So raw materials. What other terms might you, well, what terms come to mind when you think of raw materials? Stock, inventories, goods for sale. Yep. These are all different names of inventory. So stock in hand, goods, raw materials, product. So when I think of raw materials, and again, this is probably just because I lecture on this year in, year out, I think of 3 classes of categories when I think of raw materials. I think raw materials coming in, then they somehow get worked on, so I have work in progress, and then they somehow get turned into finished goods. So I think of raw materials, work in progress, or WIP, W-I-P, and then finished goods. So very good. That's probably sufficient for that question. So just be aware that the point of this question is when you are looking through your company's annual reports for inventory, just beware. It may be there, but under a different name. Okay, that's a really important point because a lot of students get to step 7 and they think, oh, I'm going to Google inventory or find Control F and find inventory in my PDF annual report, and nothing comes up for inventory. Like, oh, my firm doesn't have inventory. So then they send me their annual reports and have a look, and I'm like, oh yeah, it actually does. It's just called this name. So what I would like you to be able to get out of today's lecture is, where do you look for inventories in your annual reports? What sort of names may it be under? And also, where else might you look for inventory apart from the one major statement we usually put it under? What other areas of your reports might you like to look for inventory under? So, because you will need to do that for step 7. So that's my goal. Let's keep going. Now, so we know what inventory is, okay? It's basically anything that we want to sell in order to make money out of it. That's what we've established so far. So why do we need to account for it? Okay, well, we need to know how to manage our inventory in order to make money out of our inventory. Otherwise, what's the point, right? Have you ever gone to your pantry to get something out, only to find out that it's gone off and you can't use it? Am I the only one with that? No? Everyone's nodding. I guess everybody has at some point gone to get something and it's gone off. You can't use it. That's all part of what we call in our unit inventory management. Okay, it's not just the cost of the food in your pantry, it's the cost of storing it there in your pantry, because whilst it's being stored there, you can't use your pantry for anything else. Okay, you've got to use it for storing the food. There's also other costs such as wear and tear, obsolescence, which is our fancy word for things that go off, and wastage. And in some businesses, there's also the cost of theft as well. We have to account for all of those costs. In Australia, we have to account for inventories according to the accounting standard AASB 102. This standard tells us that we have to account for inventories according to the lower of cost or net realisable value. Now, just before I go through that, I've put on here a link to the standards page, aasb.gov.au, and I always just like to point this out. So if you just pop that into your browser, it'll take you to the Australian Government site, which is our Australian Accounting Standards Board's website. And under quick links here in the middle, the very first quick link is called Table of Standards. Now, years ago, it used to be not as nice and easy to find as that. But nowadays, they've realised a lot of people actually do refer to the standards. So if you click into that, it will actually list all of our AASB standards numerically. If you scroll down to 102, which is inventories, you might like to refer to that as you're writing about inventories as part of step 7 in your assignment. Look, they aren't that riveting reading, but they are the guiding standards on how we account for inventory. So at AASB 102, this is everything that I'm going through in the lecture today, everything that's presented in the study guide is based around our accounting standards. And remember that Australia has become harmonised with the International Financial Reporting Standards. We harmonised back in January 2005, 1st of January 2005. So our Australian accounting standards are harmonised with the International Financial Reporting Standards. Okay, so I will flick back to this standard. So if you'd like to open it and keep it open as well, you might like to put notes or electronic notes in for step 7. All right, so check out that inventory standard. Now, coming back to, so AASB 102 tells us we have to account for inventories according to a rule called the lower of cost, or NRV, or net realisable value. So this is the rule. It's a simple rule because the name is the rule. Okay, we either have to value our inventories on our balance sheet at the lower of the cost, so i.e. what is cost to the business to purchase those inventories, or net realisable value. Now, net realisable value is what we call the selling price minus any costs of sale. So what we could get for them if we tried to sell them in the market, which may not be what we paid for them. I mean, ideally, we'd like to get more than what we paid for them, but sometimes due to different factors, might have gone off, or there might be obsolescence, wear and tear on certain inventories, and we can't sell them for what we paid for them. We then have to value that, and we call that an inventory write-down. So we have to value the inventories on our balance sheet at the net realisable value. What can we realise these inventories for? What can we actually sell them for now? So it's the selling price minus the cost of sale. So most of the time, hopefully they're valued at cost, but sometimes we have to value them at net realisable value. So we have to actually write our inventories down, i.e. we have to credit our inventories. So the journal entry to write them down would be to credit the inventories and debit an expense. Okay, now I'm going to pick up on that again when I show you Wes Farmers. In the notes, they actually tell us how much they've had to write down to net realisable value. And when I was looking through this year, in comparison to last year's lecture, the figure has increased a lot. And Martin had a big comment about last year's figure. So I'm a bit worried about what Martin might say this year about how much Wesfarmers has written down. Anyway, what I want you to remember is they're valued on our financial statements at the lower of cost or net realisable value, okay? So cost is what we purchased them for, NRV is what we can sell them for. Okay, so the idea with inventory, we hope to sell them for more than what we paid for them so we can make money out of them. Sometimes this isn't the case for some reason, such as wastage or obsolescence. So what we can sell them for is sometimes below what they cost us. In this case, we have to value them at that lower cost on the balance sheet. But in most cases, we would hope to be able to sell our inventories for more than what we've paid for them. So we would simply value them at cost on our balance sheet. So in most businesses, this would be the flow chart. And in a lot of retailing businesses, inventory represents a large expense. Indeed, that's the case with my company, Wesfarmers, particularly since it owns a number of retail companies. The accounting standard also goes through in some detail a variety of methods and cost flow assumptions which can be used to account for inventories, and we're going to go into detail in some of those today. In effect, those cost flow assumptions are the means of moving that value of our inventory from our balance sheet to our income statement. Now I'm just going to flick through to show you this diagrammatically because I'm a little bit visual, so I like to show you in a more visual way what this slide is trying to say. Okay, so I'm going to draw two statements. So we've got a balance sheet here, balance sheet, and then we've got an income statement. Okay, so we have our inventory sitting here as a current asset. Let's just put $100, okay? This is where they sit when we first purchase them, okay? When we sell them, we transfer them over to this statement. We transfer them off our balance sheet when they're sold so that we can calculate a profit. Okay, because when we sell them, they're no longer an asset waiting to be sold. They become a cost of sale. So we actually call them cost of sales or cost of goods sold, COGS sometimes, which is the expense relating to the sale that we made out of them. Okay, so the difference between the price that we sell them for, which is the revenue that we recognise in the income statement, and the price that we paid for them, which is the cost of the sale, that becomes our gross profit. Okay, so we do it via a journal entry. So we usually debit our cost of goods sold or cost of sales, and we will credit our inventory. Let's just say for $20 that we've sold. Okay, so they sit here when we purchase them. We put them on our balance sheet. When we sell them, we take them across. Okay, so to summarise it, when we buy our inventory, we record them at cost. That's the cost that we've paid for them. Unless they decrease in value below what we can sell them for or below their cost, they will remain sitting at this cost price on our balance sheet as part of inventory. When we sell them, then we do this journal entry to transfer the cost of that amount of inventory sold across to the profit and loss. So in this example, I'm just going to say $20. Okay, this amount is known as the cost of sales or cost of goods sold. So if I put the 20 here, this would then decrease to a balance of 80 remaining available for sale. So at any given time, we can see the inventory that we still have left available for sale, sitting as a current asset on our balance sheet as part of what we call the ending inventory at any point in time. We can also see on our income statement or our profit and loss statement how much inventory we have sold through this expense item called cost of sales or cost of goods sold. Okay, now there are a number of methods and systems which we can use to account for our inventory. So flicking back to our slide. So diagrammatically, this is what I've just gone through, this first dot point. There are two distinctly different systems. So we're going to start with these two main types of systems which we can use to account for our inventory. So we'll go through the difference between the perpetual and the periodic systems. The perpetual system is exactly what the name suggests. It perpetually or continually So perpetual means ongoing. So perpetually or continually keeps track of your inventory movement. So most businesses use that today, predominantly because we have nice electronic means of keeping track of our inventory. It does involve keeping current and continuous records of all inventory transactions, and it has a separate inventory subsidiary ledger. We learnt about subsidiary ledgers previous weeks thanks to Karen's lectures. Okay, so subsidiary ledgers provide additional detail to something in the general ledger. So we have a separate inventory subsidiary ledger which contains a unique file for each inventory item that our business sells. This allows the system to keep track of the quantity and unit cost for each sale or purchase of that item, and also to keep that running inventory balance on the balance sheet and also on the income statement, the cost of sales. So you can tell at any time how much of that inventory item you have available for sale. Well, that's what it's supposed to do anyway, but in real life, the inventory balance could differ from the actual inventory that's physically on hand due to many reasons, some of which we mentioned before, such as theft, unfortunately. So we still need to do a physical stock take to check that our balances do balance in our books at the end of each period. Now, on this slide, I've just put an example of an old inventory record card, just so that you get the idea of what kind of information can be stored for each inventory item. In practice, computer files can present this in different ways. As long as the information is there, that's the important thing. We don't really care about format. In this example, you can see the name of this particular inventory item, i.e. it's a fridge, and its inventory code that the business uses for it. And also you can see there is a minimum and maximum stock points for ordering, and also the movement in the stock during the period. So you can see there's a balance, so beginning balance at the beginning of the month. Then we've had purchases added to it, sales reducing it, purchases returns again, so that's reducing it, so that's us returning something we've purchased, and also sales return, that's our customers returning something they've purchased to us, which increases the balance. Unless it's faulty, in which case we have to write it off. Okay. So, as you can see, the inventory account on our balance sheet is perpetually updated, as is the cost of sales account. So this inventory balance under the perpetual system, that's constantly updated, as well as our cost of sales account. That's also perpetually updated under the perpetual inventory system. So in the income statement, we can simply list that cost of sales as one line, as I've just shown you on my diagram. Contrast this to the periodic system, which we'll go through next. Now, on the next slide, I've put an example of the income statement shown for a perpetual system. Note that the cost of sales can simply be shown just as one line. Most of your companies will be using this method. Okay, so this is something you can explore and discuss as part of your assignment. So this might be a big hint as to whether they do whether your company uses the periodic system or the perpetual system, which is one of the questions we ask you in step 7. How do you know which system your company uses? What are the little hints that tell you that it's using, for example, the perpetual system? Well, there's actually one line for cost of sales, or they've actually included a calculation in my income statement for cost of sales, which I'll show you in the next system. Okay, so that's something we'd like you to explore in your assignment. Now, periodic inventory system. So we've just come through the perpetual one. The periodic system only accounts for inventory movement at the end of a period, hence the name periodic. The inventory account on the balance sheet is not constantly updated like in the perpetual system. So this inventory balance here, 100, stays at 100 until we update it manually, periodically, okay? So under the perpetual system, every time we have a transaction, this is updated.
What's the point of a periodic inventory system then? Because if the perpetual one is just constantly updated, doesn't that help for everyone?
Oh, we'll go through that, Maitland. Definitely. And which one should you use if there's two different systems?
Well, I would use the perpetual one.
But it's a lot more work. What if you've only got a really small business?
Yeah, okay. So my thinking behind it was that there might be a program to do the perpetual inventory system.
Oh, look, there is. And most, yes, you're right. So it does come down to a cost-benefit analysis.
Yeah.
And most companies do use an electronic system to keep it updated.
Yeah, of course, I understand that. Yeah, we're obviously learning this for a reason. I get that. Yeah, but yeah, that's why I was like, why would we do periodic?
This is very good. This is an excellent question.
Yeah.
And I will cover that. I'll point your question out. It's actually at the end of this system. I'm pretty sure I'll go through the comparison.
Of course, but we need to understand.
But you need to
why
understand
we're
it. Oh, yes, that's right. And you need to explain back to us about it in your step 7 of the assignment.
Absolutely.
Okay. All right, so the beginning balance of inventory is not changed until the end of the period, okay, when we periodically update it. So we record all of our purchases in what we call a purchases account, and the cost of sales then is manually calculated at the end of the period. So we actually have to have a formula for this. We also then have to do a stock count or a stock take at the end of the period in order to determine the ending amount of inventory that we need to adjust on our ending balance of inventory value on our balance sheet. Okay, so we need to calculate that we need to decrease it by $20, and we have to make sure that this $80, so we do a stock take to make sure that we've actually got $80 worth of inventory on hand at the end of the period. Okay, we need to determine the amount that we need to adjust our ending inventory to. Okay, so that's why we do the stock take as well as a check. So in this case, our inventory account on our balance sheet is not continually updated. Neither is the cost of sales account on our profit and loss statement. Okay, so flicking back to this slide. In the income statement, we have to show the calculation for the cost of sales. Now, here's the formula. That's a very simplistic version of the formula. It's the one that I think about. So I always go COGS equals opening balance plus purchases minus ending balance. Now, the simplicity comes here because there are a number of different things that we add and subtract in determining what is our purchases figure. And I'll point this out again when we go through and look at the Wesfarmers accounts. So you'll notice Wesfarmers will tell you in the inventory note how much is the cost of inventory that has been moved from the balance sheet to the income statement. And then we can go to the income statement and check that figure, and you'll notice it differs a little bit. And it differs because there's a number of different things we add and subtract in calculating the cost of our purchases, such as, let's have a look at this example. Okay, we've got, in this case, we've got our beginning inventory. So this is the overarching formula. Opening balance plus purchases minus ending balance equals cost of sales. Okay, that's our formula from this slide. So opening balance plus purchases minus closing balance. So opening balance is here, plus purchases minus closing balance. But look what's involved in calculating the purchases. Okay, we've got the actual raw cost of purchases, then we're also adding freight inwards to it. Then we take away purchases returns that we've returned to the supplier because we've actually returned them. And then we also take off any discounts that our suppliers have given us because that reduces the cost of our purchases. So you can see there's a number of different things that we factor into. So we don't just lump just the raw cost of purchases. There's a few things that we add and subtract. Okay, and we call that the cost of net purchases. So it's opening balance plus the cost of net purchases minus closing balance. And that equals our cost of sales. Now, another thing I wanted to point out on this slide is if you studied inventory before, you've done accounting, just finished doing accounting in high school, and I know there are a couple of students who have done that, you might have heard something called COGAS, so which is the cost of goods available for sale. That's this line here, cost of goods available for sale, COGAS. And the formula, you used to have to sub the formula to the middle. So you start with opening balance plus purchases equals COGAS, so our cost of goods which we actually have available to sell to our customers, minus what we've got left on hand at the end. The difference must be a cost of sales. So again, just diagrammatically, just quickly show you. There's another little diagram that I use. So if you think about our purchases as a nice big bundle of things, so we have our opening balance. Then on top of this, we add some more purchases, so plus our purchases. Okay, this is what we call our COGAS. this is our cost of goods that we have available to sell to our customers. We have what we started with, then we lump some more soil or whatever it is that we've purchased on top. So we've got an opening balance plus some more of our purchases. This whole thing we've got available to sell to our customers. How do we know at the end of the period what we've sold? Well, we assume, so time goes past, and this is our pile left after we've sold. So this is our closing balance. Okay, so we say, okay, at the beginning of the period we had something we started with, we added all of our purchases to it. We don't know what we've sold in the meantime, we have to calculate it. How do we calculate it? Well, this is what we've got left now. So let's take that away from our COGAS. So this is our cost of goods available for sale. This is our ending inventory. So we simply take that away, and the difference must be, obviously, what we sold to customers in the meantime. Okay, so the difference must be our sales. We call that our cost of sales, because that's the cost, the raw inventory cost. So that's the logic behind that formula. Opening balance plus purchases minus what we have at the end of the period has to be what we've sold. Now that's a very simplistic version, and as I've already alluded to, in here, in the cost of sales, can also be the cost of theft, the cost of wear and tear, the cost of obsolescence. We don't know because we've only calculated this at the end of the period. So we literally lump a whole heap of other costs into cost of sales as well. All right, so that's periodic system. Now we get to Maitland's question. Why do we have to do? Which one would you use, and why wouldn't you just use the perpetual system? So as you can see, there are a number of differences in our financial statements between using that perpetual versus a periodic system to account for our inventory. For example, the cost of sales under our income statement is already recorded under the perpetual system. Under the periodic system, we have to calculate it at the end of the period using that formula I just went through. Same with the ending inventory balance. It's not perpetually updated under the periodic system. So the perpetual equals more work. Sorry, let me flick back to the slides. Here, I'm reading my slides. The perpetual system is more work, but it's more detailed and there's more control over it. Although this is automated these days through electronic systems in our modern world. The periodic system, though, is less work because you only have to do it once at the end of every period. Once at the end of the year if you're small enough. But again, the cost is that it's less detailed, there's less control over it. So which method should you use? Well, for most businesses, it comes down to a cost-benefit analysis. But unless you are a really small business, you will opt for using the perpetual system, as Maitland pointed out. And you'll be able to explore this more in your allocated company as well. So the next two slides I've put are simply for a reference for you, particularly in relation to step 7. So you can come back, it's like a little summary. It does contain a summary actually of the two systems, okay? So there's a summary of the perpetual and then a summary of the periodic system. And of course you can also read about these two systems in the study guide, chapter 4, section 4.2, which contrasts and explains in more detail, again from a different perspective, about the perpetual and periodic systems. All right, now we're going to move on to looking at the methods of accounting for inventory. The study guide refers to these as our cost flow assumptions. If you recall this slide, which I've put up on the PowerPoint slides now, this was showing an example of that fridge inventory record file. What we're actually going to look at now is how do we value our ending inventory on our balance sheet, and hence how do we value that cost of goods sold on our income statement. So how do we calculate this figure? There are 4 methods of inventory cost assignment. So there's specific identification, first in, first out, last in, last out, and the averaging method. And there's 2 different averaging methods depending on whether you're using the periodic system or the perpetual system. So that we've got the weighted average for the periodic method and the moving average for the perpetual method. So let's look at these in a bit more detail. And for step 7, I would expect you to discuss these cost flow assumptions as a very minimum. So we'll look through all of them. This is the example that we're going to use when I'm demonstrating the different methods now and cost flow assumptions. So the scenario is we started off with 10 units on hand, valued at $10 each. Okay, so we've got the total cost is $100. That's our beginning inventory on our balance sheet. Then during the period, we purchased an additional 27 units. Okay, so we had 37 that we could sell to our customers. Notice that we purchased these 27 at different prices. We had 12 purchased at $11 each, and then we had another 15 purchased at $12 each. Okay, now we sold 18 units, but the question arises, what amount do we put on these 18 units that we've sold? And what value do we use for the 19 units that we have left in our ending inventory? This is where our cost methods come in. Depending on which one we use, it will make a difference to our financial statements for our current period. But over the long period, it should even out, and we'll go through that after we look at each of the methods. The first method that we're going to have a look at is specific identification. This method assumes that we can specifically identify each individual item that we sell and the price that we paid for it. So think of like a car dealership or a yacht building company. We can usually easily identify the exact cost for each vehicle or each yacht that we sell. In this case, it's easy to specifically identify the cost associated with each unit. So we could specifically identify each of the 18 units sold. So let's just assume this. Let's just assume as follows on this slide, okay? So let's assume that if the 18 units sold was 1 unit from the beginning inventory, we would value that at the $10. That there were 12 units that we could specifically identify from the first purchase at $11, and that there were 5 that we could specifically identify from the 7th December purchase at $12. So we would then just multiply the cost of those units out by each of those prices and sum those 3, so the $10, the $132 and the $60. So we would say, okay, the 18 that we sold, we are valuing them because we can specifically identify them. So our total cost of sales for the period is $202, and therefore what's left is 9 units from beginning inventory, because remember we had 10 and we specifically identified that we only sold 1 from the opening, so we still have 9 left. So we have 9 from beginning inventory. We specifically identified we sold 12 from this purchase, so we sold all of these, so we have none of those left. So we have 0 units valued at 11, and then we only sold 5 from the second purchase. So we specifically could identify we sold 5 of these. So we have 10 of those left at $12. So we have 10 units at $12. So again, we simply sum the $90 plus the $120, so we know that our ending inventory is $210. Now, in many cases, such as for companies like Coles and Woolies, who sell lots of the same item, like loaves of multigrain bread, it's hard to apply specific identification. So which loaf just walked out of the door in that customer's shopping trolley? Okay, so it's clear that specific identification wouldn't be practical in that instance. In the accounting standard, AASB 102, paragraph 24 actually says that specific identification is inappropriate when there are large numbers of items in inventory that are ordinarily interchangeable, like loaves of multigrain bread. Okay, so specific identification isn't practical when we've got large items which are fairly homogeneous. So we'll go through these next methods now that we can use. Now for the miners out there, no, FIFO doesn't stand for fly in, fly out. In this case, it stands for first in, first out, okay? So the first in, first out method assigns inventory costs on the basis of the cost of the first units of inventory purchased, hence the name. So in our example, we would assume that we sold the opening inventory that we had on hand, i.e. the 10 units at $10. Okay, then we would have sold the remaining 8 from our 18 units from the September 15th purchase at $11. Okay, so it's assuming that the 18 that we sold was the very first lots of units we had, then the next lot. So 10 from the beginning inventory and then the remaining 8 from the next lot of purchases. So that's how we value. So the cost of sales under the FIFO method is $188. This means then that we'd have nothing left from the beginning inventory, only 4 units left from our 15th September purchase at 11, and we'd have all of the units left from our second purchase on 7th December at $12 each. So the value of our ending inventory is $224. It's the 4 units from our first purchase and all of the units from our second purchase in the period. Using this method, we've assigned the value of the first units of inventory purchased to the first units sold. Hence the name first in, first out. These were the first items we got in. They were the first items we sold to customers. Yeah, almost. Okay, the last in, first out method, the LIFO method, is the opposite of the FIFO method. The LIFO method assigns inventory costs on the basis of the cost of the last or most recent units of inventory purchased. So in our example, we would assume that we first sold the most recent inventory that we purchased, i.e. the 15 units from our December purchase at $12. Then we would have sold the remaining 3 of the 18 that we sold from the 15th September purchase, the earlier purchase, at $11 each. So our cost of sales would be $213 in this case under the LIFO method. That means then, out of the 19 inventory units we have left on hand, that we'd have 9 units from our 15th September purchase at $11 and all of our opening inventory valued at $10 each. Okay, so our ending inventory would simply be the 199. Using this method, what we've done is we've assigned the value of the last inventory purchased to the first units that have been sold. Hence the name last in, first out. Now in Australia we can't use the LIFO method. AASB prohibits the use and the study guide explains the main reason why. So have a read about that in the study guide, page 4-12. So if you scroll down to page 12, you'll have a little read about the reason why we can't use the LIFO method. And it might make a good pairwise question. Hint, hint. All right, moving on. Hang on, we've got a question.
I don't really know how to articulate this question. I'll give it a go. Because obviously we're talking about calculating here, but I was wondering with the LIFO method, obviously in a business you generally sell what comes in first anyways. Are there business models that will work alongside this accounting method and then sell inventory that comes in most recently? And is that why this method's available? Or?
Oh, look, you're on the right track, Maitland.
Yeah.
Yes, and again, it's got to do with periods of rising prices.
Yeah. Okay.
So
yeah.
Look at the economic conditions, I guess, surrounding your business. And in most cases, prices do this.
Yeah.
And hence why it's sort of inappropriate to really use a method which values the most recent prices first, essentially, because by the time you get to the original prices, and
it's going to be way too far behind.
Exactly. Yeah. So, but that's one side of the ball.
Okay.
These are excellent questions, and this is exactly what we'd like you to explore as part of step 7. We want you to start pondering, why is that the case? Why can't we use it?
Yeah.
And then we want you to find out why, and then let us know what you think. It's very good. All right, so the last method that I'm going to go through today, so we've been through specific identification, FIFO and LIFO. Now we've got the averaging methods, all right? I'm going to go through the weighted average method. Both averaging methods are essentially the same. The moving average obviously calculates this every time. The weighted average will do it at the end of a period, but essentially both are calculating the same for each different system. So the fourth method that we can use to value our inventories is the weighted average method. Now, it's kind of a balance between FIFO and LIFO, as the name would suggest. It is a weighted average, okay? It calculates a rolling average cost of inventory, and then it just applies that calculated flat rate to all of the items of inventory sold. So the formula is fairly simple. It's price divided by quantity, okay? i.e. what's the total cost of the units that we actually have for sale divided by the total number of units that we have for sale. So for example, in our example, for example, the total cost of what we have available for sale here is $412. That's the total cost of the goods available for sale. That's the price, the dollar value. And we divide that by the units that we have, so the actual number of units that we have available for sale. So we divide the 412 by the 37 units that we have. So when you do that in your calculator, you get 11.135, so round it to about $11.14. And you simply just use that figure to apply to the 18 units that we sold and to the 19 that you have left in ending inventory. So it's a nice, easy calculation, as long as you get these figures right. So 412, what we have available for sale, divided by the number of units we have available for sale, gives you the weighted average, and you just apply that weighted average to units sold to get your cost of sales, in this case $200.43, and also you apply that same number to the ending inventory balance. So ending inventory is $211.57. Okay, so over these four methods, you can see it does make a difference to our financial statements. So coming back to Maitland's line of questioning, which method should we use? Okay, here's a comparison. Let's have a look. All right, so look at the values for cost of sales here under each different method. We've got 202 under specific identification, 188 under FIFO, LIFO's 213, and weighted average is sort of between these two at 200. That's cost of sales. Again, look at the value of ending inventory reported on our balance sheet. 210 for specific identification, 224 for FIFO, and 199 for LIFO. This is coming back to Maitland's line of questioning. The lower value on ending inventory in a period of rising prices. Is it suitable? And again, somewhere between these two is our weighted average ending inventory reported. Now, these are the sorts of questions I want you to ponder. Okay, why is this? Why are there differences between them? And we've been through pretty much why over when I was going through the methods. Another question?
Not that I would ever do this, but it seems like with the LIFO method, it would be easier to launder money. Because you could just cut off your profits, right, off the end result and then just keep it for yourself.
Look, I'm not encouraging unethical behaviour in this unit.
But I'm just saying, maybe that's why they forbid it.
There is a lot of room for manipulation in the financial statements, and this is one area where they can be manipulated.
That's what it looks like.
In order to curb some of that, there are policies again. So firms can choose, for example, to change some of their policies. They may be able to use FIFO in one period and then specific identification in the next. Okay, but if they do that, they have a number of requirements. For example, one of them is the restating. So in their financial statements, then if they've changed accounting policies, they have to go back and restate prior year comparatives as if they've used that new accounting policy.
Right.
They also
restated financial statements sometimes.
Exactly.
Yeah.
And they also have to disclose in the notes to their accounts that they've changed it. Okay, so and that's usually disclosed.
What they've changed specifically.
Yes, they do.
Right.
So there are rules. So it can be manipulated, even within the rules. And this is just one area. And these are all the sorts of questions we like you to explore. So they're fantastic questions. Thanks for raising them. All right, so discuss these sorts of things with your peers. Read about it in Chapter 4 of the study guide and create some great peer-wise questions surrounding the concepts, all right? Okay, so given the different values for cost of sales and ending inventory on the previous slide, you might conclude that the different methods result in different profit on the income statement and different values in current assets on the balance sheet. This might be true in the current period, but over the long run, eventually all of the inventory will be sold and all of those purchase costs will be allocated to sales. So long run profit will actually be the same. What differs is the timing of the recognition of those purchase costs that we assign to the cost of sales. So what differs is the timing. In which income statement do we recognise those costs? That's the area for manipulation. So what differs is the timing of recognition. But overall, in the long run, eventually this $100 will be absorbed into the income statement in full. So long run profit will actually be the same. Now, I've put again a few summary slides of comparison for you to consider further on the topic. You can refer to these when you're thinking about your peer-wise questions that you might like to create about this concept, and also when you are completing your Step 7. So I'll put a few sparking your thoughts questions in there. All right, a quick note on inventory errors. Okay, so everyone makes mistakes. And if you've ever been involved with a stock take or any sort of inventory management, you'll know that errors are made in the real world. In a perpetual system, we do a stock take to check the balance of our electronic records. Differences might be due to errors made, such as inaccurate recording or user entry error, or due to other things like theft, damage, or obsolescence of goods in transit. So we have to make adjustment for these in our electronic records. Now, I know we've got a lot of students who've got some great work experience out there. So are there any students who've actually been involved with a stock take and or have had to adjust for errors or match numbers of physical stock on hand to the numbers in their systems that can share a nice story for us to remember? We'll start with Maitland because he's got one.
I used to be an inventory coordinator and an analyst at John Deere Vanderfield in Mackay. This is what I did last year before I started uni. And basically my whole job was I was contracted to create a new inventory system because theirs was so outdated that they just kept losing track of all their stock. And after I went through the thousands of parts that they had in the store, I found heaps and heaps of parts that they hadn't accounted for that were in the business. So I actually had to increase the amount of stock that they had by heaps. Like they had things sitting up in their attics and everything up the top, like thousands of parts up there. So I had to bring them down and put them into boxes and figure out, just how much they'd actually missed. So they ended up making a massive profit, I guess you could say, because they ended up with so much more inventory than they had previously on the books.
Oh, they would have loved you. you found figures out of nowhere for them. Did you have to adjust them on the financial statements, or did somebody else do that?
I didn't do that. So my job was to add that into the system of the actual number of individual stock that they had for the part numbers, and then add the amount of parts that they had for that part number. And then obviously someone else would probably have to sort all the pricing.
That's right. Very good. So, and again, that's a good internal control, separation of duties.
Yeah.
So you inputted the quantity of stock. Somebody else then put the dollar value on that stock. Yeah. I would dare say it would be their accountant. That's very good. So that's kind of the opposite, really. You showed that you increase their inventory balance instead of having to have a write down.
Yeah.
I think our Wes farmers might need to employ you. We'll have a look at Wes farmers soon. They've got a large amount of write downs. Any other students have any cool stories to share with us? There's got to be somebody else apart from Maitland. Usually we have a few cool stories. I can see Rockhampton having a nice discussion.
I think he's talking, but his voice isn't coming through.
No, that's good. Everyone's got their microphones unmuted. Well, in the periodic system anyway, we do a stock take to actually value the ending inventory. So, and under perpetual, you're right. We do it to check the balance of our electronic records. In the periodic, we actually need to determine our ending inventory because we don't know because we haven't been perpetually updating it. So in the periodic system, we do a stock take to actually value ending inventory, and we can also make counting and pricing errors as well. I think last year we had a student who shared her story, and she worked in Kmart, and they do that with the RFID, the radio frequency ID tags, to value their different stock. It's all electronic, so they can walk around with your little stock guns now, and they zoot all the stocks, and it automatically updates the quantity. And if you've ever seen, like, walking into Bunnings or one of those really large retail type of stores, you'll see staff at stock take time, and there's a whole line of them in the shelf, and they're doing this, doing the manual stock take. It's very laborious. But there still can be errors made even in counting the actual stock take. She was saying with theirs, sometimes the system wasn't even correctly picking up when they were entering it in. They had some of the problems with the RFID readers as well. So people make mistakes. So there will be errors in your inventory, and it's actually more common than not. But over 2 periods, all inventory errors will even out. And if you think about that concept, you will understand why that is, okay? And actually, that would make another good peer-wise question. So I'll give you a hint. Ending inventory from one period becomes opening inventory for the next. Okay, let's move on from inventory errors. Presentation in the financial statement. So the accounting standard AASB 102 does dictate how firms need to present their inventories in their financials, which includes disclosing suitable sub-classifications relevant to a firm's inventories and the valuation basis for each. Okay, so most firms will actually put sub-classifications in the notes nowadays. They'll actually have a lump sum for inventory, and then they'll put sub-classifications in the notes, and Wesfarmers does that. So as you look through your companies, you'll notice that your firm might call inventory different names, such as raw materials, work in progress, stock, finished goods, etc. Some firms also call cost of sales different names. Okay, so this is this particular one. So there's lots of different names for this, but there's also lots of different names for this. So it can be called cost of sales, cost of goods sold, inventory recognised as an expense, raw materials or inventory, stock sold. So take the time to explore your firm's inventory practices is the important point. Okay, we want you to spend the time exploring it. And you need to report about this in step 7 of your assignment. So talking about your assignment, we're going to duck there now. I'll briefly go over the requirements of the assignment and then show you my company. And then in the tutorial time, you can begin to work on this step if you haven't already, and we'll finish off with the minute paper. Okay, so quickly opening the assignment. So step 7 involves you exploring the inventory practices of your firm. It is in chapter 4, okay, and there's also a number of videos to help you complete this step. Inventories often form a significant part of a firm's business, although not all firms have inventories. For example, Ryman Healthcare doesn't have any inventories. So go to your firm's annual reports that you downloaded as part of step 3. Open each soft copy file, it's an electronic file, usually PDF documents, and search for where inventories is referred to. You may find that your document has a search function. So for me, with Wesfarmers, I just put Control and F, I just press Control F. You can also find comments on inventories in the notes to your firm's financials, and I'll show you that with Wesfarmers. Read these comments to get a feel for how your company manages its inventory. Make sure you do this for every year which you've downloaded an annual report for. So I'm just going to show you 1 year, but you need to do it and talk about it in step 7 for all of the years, okay? As you're doing this, write down the key concepts that you find interesting, whether they relate to each year or just 1 year. You've probably already started doing that, this lecture, but as I said at the beginning, you've probably got lots of notes, especially if you've had the standard open as well as the slides open in your assignments. You will find specific information about your firm's inventory policies as part of the detailed notes in the financials. Note the figures for inventories in your firm. Are they large or small numbers? What do the figures actually mean now that we've been through them today? You might find that your firm's note on inventories contains key terms such as raw materials, work in progress, finished goods, net realisable value. What does your firm disclose and not disclose about its inventories? Has your firm changed its inventory practices over the years that you were reviewing? If so, why has it done that? And Maitland's helped us today with answering that. Have they changed it? Have a look at the beginning notes to your accounts. They may have. They may provide the explanation of why. How might this have affected your firm's financial statements? Does your firm disclose what type of inventory system it uses, perpetual or periodic? And if it doesn't, how can you tell? What are the tips and hints? And I gave you one or two of those today. What method of inventories does it use? The cost flow assumptions that we went through today. What are some of the associated issues and costs that your firm might be facing with its inventory management? Why might this be the case? Are there any areas where you think your firm could improve its inventories management? How did you identify these areas? If you have had any experience with inventories, make sure you also describe these experiences. Okay, so there's lots and lots of thought-provoking questions there that we have given you to try and spark your response to step 7 and really, for you, take you on your learning journey in understanding inventories and making it personal. And hopefully you will remember it rather than just giving you an assigned task to calculate, do a journal entry, and then you forget about it in the real world. So if I was to start doing this for Wesfarmers, I would go to my Wesfarmers annual report and Control F, type in inventories and hit search and see what happens. Okay, here we go. It's brought me to the balance sheet already. Now, I'm lucky. It just happened to be the word I typed in. You may get nothing when you do this, and in most cases your companies may not have called it inventory at all. So it might not even be called inventories, it might be called inventory. It might be called stock on hand. So you may have to change your search terms to try and find what your company is calling it. Now, if all else fails, or if you just can't be bothered doing Control F, just go to your financial statements. So scroll down to your balance sheet, because we all know, we've just seen today, that inventories is a current asset which can be found on the balance sheet. So in Wesfarmers' case, we can see that inventories is listed as a current asset on its balance sheet, and that it represents actually quite a large portion of the total current assets. So if I was to calculate that, it would be, let's calculate it as a proportion. So 6011 divided by 8706. So I just want to calculate what proportion of current assets it is, times 100. So 69% of their current assets is actually tied up in inventories. That's a large proportion, especially when you contrast it to, say, for example, Martin's company, Ryman Healthcare, which has no inventories. So, you know, one company has 0 inventories, one company has 70% of current assets as inventories. All right, so of course you're looking at different industries, different types of businesses. So we want you to start exploring those. Now, I can actually see in note 6 the breakdown of these inventories that they've listed on the balance sheet. So I can go down to note 6 and have a look in more detail at this figure, and I'm going to do that soon. But before I do that, what's the other income statement? Sorry, what's the other financial statement we might like to look at? We know that inventories is found on the balance sheet. We also know that the cost of sales, which is where we move this once it's sold, can be found on our income statement. So if we go to the income statement, just have a look. Let's see if we can identify where Wesfarmers might have put it in some of these expenses. And this might give me a hint as to what type of system it uses. So I can see there's one line that it might fall under, and it's called raw materials and inventory. So it's not called cost of sales. Wesfarmers has called it something different, okay, and that would be the same with your firms. They might not have called it nice and neat cost of sales or cost of goods sold. In most cases, they will give it a different name. You have to think about it and think, what does my firm do? Is this likely to be its cost of sales? So in this case, raw materials and inventory is fairly likely to be the cost of sales, or the movement from the balance sheet to the income statement. So just have a look at this figure. It's quite large. It's $45 billion, 45,718 million. Okay, so $45 billion. I'm going to come back to that figure. Just remember 45 billion. Let's go down to note 6. Scroll all the way down till we get to note 6. Here we go. Note 6 on inventories. So we can see in a little bit more detail what my $6 billion worth of inventory on my balance sheet is made up of. It's made up of raw materials, work in progress, and a large amount of finished goods. Remember, Wesfarmers owns a lot of retailing companies.
Yeah.
Okay, so
Will those raw materials be like, you know how there's like Wesfarmers with Woolies, isn't it?
no,
Coles.
well, yes, it was with Coles. It's
Yeah.
still, anyway, yes.
But you know how there's like Coles branded like foods products. Would that be why there's raw materials in something like that, because they're making some of the products themselves?
Well, Wesfarmers owns a number of different types of businesses.
Right.
So some of those businesses are not even retail, they're manufacturing.
Yeah, gotcha.
And in their manufacturing businesses, which are a smaller portion of Wesfarmers, they will have raw materials and work in progress. But because they own such a large number of retail businesses, you would expect to see the majority of their inventories as finished goods because they're in retail. But that's good. Know what your company does because it will factor into their inventories. Now, look at this figure here. Inventories recognised as an expense for the year totaled $50 billion. So this is the amount that has been recognised as an expense, i.e. this is the amount that Wesfarmers has done in a journal entry to move from the balance sheet over to cost of sales. Okay, so they're saying they've moved an amount of $50 billion. But on the income statement, we saw it was $45 billion. Okay, and just remember, it's not just this raw cost of inventories, it was also a number of other things we added to and took away as well. So all of those other smaller things that we added, so freight costs in, purchases, returns, the discounts received, etc., they all added to about $5 billion. Okay, so that's how you can, so again, we want you to talk about that. So, you know, I would say in the notes it tells me that we expensed $50 billion, but on the income statement it shows 45. My understanding is they would have, and then tell me about the difference and why. It also tells me that they're valued at the lower of cost and net realisable value. So I know that they're adhering to the Australian accounting standards. So AASB 102, and I would talk about that in my assignment. Okay, tells me what net realisable value is. And then it tells me a key estimate. Now, this is where it gets, well, I think it gets interesting. So this year, if I read this note, it tells me that the total expense relating to inventory write-downs was $78 million. That's the amount that they had to write down this value in their balance sheet by, okay? So, you know, $78 million to me is quite a large amount of money. I'd want to know what happened. And last year, when you compare it, they only had 11 million, which is still a large amount of money. So some of the concepts I would write about that, some of the questions I would have is, what on earth happened?
They put avocados through as onions in the salad.
Look, there will have to be a reason. And I'm pretty sure this 11 million, I think that was a decrease from the previous year. Okay, but if we keep reading, it does tell us that $66 million of that 78 was a write-down of stock made during the financial year for one of their operations. So, and they've discussed that in other areas of the annual report. So I won't go into detail now, but what I want to point out by that is check out your firm's financials and ask the questions, okay? Because there may be something like this where you go, whoa, hang on, what happened? Why did that happen? And start looking in the notes as to why did they have such a huge write-down. They may offer a very simple explanation in the notes, but this is usually detailed somewhere else in the annual report. Okay. They also tell me a little bit more costs incurred in bringing each product to its location. So raw materials is valued at purchase cost, but it's valued on a weighted average basis. So that's good. They just calculate the total, so price divided by quantity, and then they apply that to all units. Again, they're manufactured finished goods and work in progress. So again, cost, retail and wholesale merchandise finished goods. So for most of that comprises a large portion of their inventories. Again, on a weighted average basis. So they give me a little bit more information that I can write about in my step 7. Do I have any questions on that so far? That's probably all I'll show you about. I mean, I could keep talking and keep talking, but really it's going to be fairly redundant given the main concepts we've already covered. So I'd like to switch over to the minute paper and spend some time, or let you have some time to ask me some questions there. So that's step 7 of the assignment. Remember, it's fairly in-depth. We do require you to go into a fair bit of depth in this step 7. It's not just a matter of writing 2 paragraphs and then moving on. We really want to see that you've delved into the concepts behind inventory, because it's everywhere in the real world. There will be some aspect of your job, of your employment in the real world, that will cover inventory or some aspect to do with inventory. Just going shopping every day, you're already involved in the inventory practices of a firm. Okay, so we've given you an indication. Please allow around 5 hours. You may spend more, particularly if this is your first exposure to inventory. So just make sure that you are considering all of the items that we've asked you to consider in step 7. All right, let's go to the minute paper and tell me, what's the most important thing you learned today and what questions still remain unanswered? I won't time you today. What's the time now? 11 past 10. So at about 12 past 10, I'll start going through your responses. Should be putting you off mute. I had you on mute.
Nah.
We've just been in Mackay. We've just been discussing, instead of doing the minute paper, whoops, peer-wise. So I encourage my students here to, as they're going through the lecture, hop on peer-wise and write some questions as we're going through it. As we cover it, put it in. And we've had that happen.
Yeah, go answer some questions, guys. Need some points.
So we were just talking about how useful peer-wise is in actually cementing topics into your brain, because you've had to think about them and write a question. All right, let's go to the minute paper. I've only got 3. What was the most important thing we learned today? So learning more about inventories within a financial statement, and that LIFO is prohibited in Australia. Learning about inventories is involved, and I will need to review it again. Now, that's very good. It is very involved. I mean, I don't think anybody ever has all the answers when it comes to any of the concepts that we cover. So inventories particularly is because they are so diverse. There are so many key concepts covering inventories. Everybody always needs to review it. I review it every year before I lecture. I'm like, oh, hang on, let me just cover these again. Make sure that, everything's still up to date and my understanding of these concepts is all right to present it. Regarding perpetual and periodic systems of accounting for inventories. Let's refresh. Okay. All right, what questions do you still have for me? What questions still remain unanswered? Flip back to the other one too. No. I did cover a lot of info today. I'm sorry if I've overwhelmed anyone. Sarah and Yvette, are you online? Are you on Zoom? Have I overwhelmed you? Mackay says yes because no one can even respond to me. Thanks for the support, guys. All right, let's go to the one question that still remains unanswered. Okay, what was the calculation Maria used when discussing her company to work out the inventories on the balance sheet? Okay, so I assume there's only really one calculation we've been through today, which was the cost of goods sold. So my formula is opening balances plus purchases minus ending inventory, minus what we've got on hand at the end, equals cost of sales. Okay, so if I write that down, so we've got cost of sales equals opening balance plus purchases minus ending balance. Okay, so that's the formula that we can use. Opening balance plus our purchases minus the ending balance. That's that's textbook formula for how we calculate cost of sales. You can talk about it, explore that in relation to your company. My diagram to do with that formula, rather than just giving you a mathematical formula, my diagram to kind of make it a little bit more visual and understandable is think about a little, dirt pile. This is what we've got on hand to start with. We pile some more dirt on top, or whatever purchases we have. Or, let's not say dirt pile, let's say a gold pile. Okay, this is a pile of gold that we have. We start with this much gold. We've purchased a bit more gold, so we're shoveling some more gold on top. So we have a larger amount that we can actually sell off and make some money out of. We don't really know because we're not keeping up to date with it under the periodic system. So at the end of the period, we have a look at what we have left on hand to sell. And we say, all right, well, we had this much available to sell, but at the end of the period, we've only got this much left. So the difference between the two piles must be what we've actually sold. It's just an assumption. Of course, there could be employees thieving some of that gold. Some gold might have gone off or, got imperfections in it and we can't sell it to our customers anymore. So we don't distinguish between that and the periodic. We simply lump it all into that expense cost of sales. That's very simplistic. So that was the formula. That was the only formula there. If that didn't answer the question, please let me know. I'll try to explain it again. No questions remaining unanswered. We have one more most important thing that you learned today. I need to familiarise myself with perpetual inventory system. So that's good. That's what we're trying to get you to do with step 7 of your assignment. Okay, now I know that Wesfarmers uses the perpetual system, but one of the hints that tells me that is the fact that they've got one line for cost of sales. Okay, they haven't had to do this calculation that I just put on the slide. So the fact that they don't show this in their income statement is a pretty good sign. They haven't just done it at the end of a period. And of course, being such a big company, they wouldn't be able to just do it. You really do with large companies and all of the subsidiaries that Wesfarmers owns, they really need to be using that electronic means, which is perpetual, updating it perpetually. Okay, all right, well, if there's no other questions, we will break to our workshop groups. And don't come to class next week because it's the break week, so I'm not going to be here. None of your teaching team are going to be here unless you've got a catch-up class, so keep an eye out for that. But during the break week, please make sure that you're still on Peerwise, doing all of your weekly tasks as set out in the weekly schedule. And then we will come back in week 6, ready to continue on, and I'll be taking the lecture again in week 6. So thank you very much for coming, and I'll see you in week 6.